Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report and discuss the implications for risk assets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we just got a new report on inflation, and there's actually quite a bit to unpack. The first thing we should say is depending on what your bias is in the market would likely change your view of this report. So it's important as an investor that we try to look at both sides of the equation. All right. And I know this can often be quite difficult to do, but it is important for us to do. And one of the reasons I say that is because you could look at this report in two separate ways, right? The first way, the optimistic view, like the glass, half full approach, is to say, well, headline inflation still went down, and this has basically just been sort of a staircase down, right? 9.1%, then 8.5, then 8.3, then 8.2, then 7.7, 7.1, 6.5, and 6.4. So from the disinflationary point of view, inflation is still coming down. Now, one thing that I think we should clear up is that just because inflation is not going up as much as it was a year ago does not mean that inflation is not still here, right? I mean, it just means it's not going up quite as much. So the prices of things can still be moving higher than where they were a year ago, but perhaps it's just not moving up as much, right? Because inflation is sort of, it's just part of our world. It's always going to be there more or less, except for maybe brief periods of deflation. But that's just the way it is. And of course, the goal here is to ultimately get back to 2% before we could likely see a sustained move or a sustained cycle of expansion. So the glass half full approach would be to say, well, technically speaking, inflation year over year continues to move down. But the glass half empty approach, or maybe the more pessimistic view, would be to say, well, yeah, it's moving down, but is the rate of change showing a sign of starting to curl back up to the upside? All right. Now, I want to try to unpack this as best we can. I want to talk about why we're interested in this idea in the first place. Because one of the things I've maintained here for quite a while now is that unless inflation reaccelerates, so these are the two things, right? Risk assets can still do okay until either you see inflation reaccelerate or you see the economy really show signs of weakness. That could be through, say, the unemployment rate rising, could be many things. But until you see either one of those things, we're still existing more or less within a transitionary period where, yes, inflation's kind of high, but it's moving in the right direction. And yes, the yield curve is inverted, and yes, there's signs that a recession is likely going to come at some point, but unless it's here now, why should the market care about it, right? And so we continue sort of just exist within this transitionary period. And so one thing, if you look at the inflation report, you'll notice is that, core services ex housing continues to remain elevated. Core goods is actually going in the wrong direction, meaning it's actually moving back up to the upside, which is not a good thing. But there are, of course, other areas that have continued to move down. Now, the one thing that I also want to take note of here is we have inflation, headline inflation moving down, sort of like on a staircase here. Now, I think one of the reasons why there were sort of mixed views earlier today when we got the report is because consensus was that it would come in at 6.2%. And it actually came in at 6.4. So 6.4 still represents some level of disinflation. Now, we need to be clear about something between these two different words, right? There's disinflation and there's deflation, and they're not the same thing, right? Disinflation would just mean that it's becoming less inflationary, but it's still inflationary, right? Deflation means you're sort of expecting prices to actually go down. But prices are not really going down. They're just not going up as much as they once were, but still going up. So we need to think about that. But in the grand scheme of things, right, consensus was at 6.2. The actual level came in at 6.4. But there's something we need to talk about here, and it's sort of the elephant in the room. And I know some people have been talking about it for a while, but it's that they're starting to use a new methodology to actually calculate out CPI, right? And in some of the sectors, and that's basically using only using one prior year of data as opposed to two, and it sort of makes tracking this dubious at best, right? Which of course is why we're going to continue to talk about it, because dubious speculation is my specialty. But it does make it somewhat dubious, and it kind of makes me think about, if you're in grad school, right? Like if you're in grad school, or let's say you're writing a research paper as an undergrad, whatever it might be, or if you went to grad school, you go through a process, right? The scientific method, you might run an experiment, you collect your results on the experiment, and then you publish the results. But imagine if you're running an experiment and then halfway through the experiment, you changed the way you calculated the results, but you didn't actually go back and change that calculation for the first half of the experiment. You just changed it for the second half, and then you published it. That would seem like a very dubious thing to do, would it not? I mean, you're essentially saying, all right, well, for a certain period of time, we're going to use one methodology, and then later on, we're going to use another methodology, but not actually try to, put these two different methodologies together. We're just going to say this is the new way we're going to do it. And this is actually something that the charts suffer from for quite some time. One of the things that you might look at with inflation, if you were to go over here and say, look at the inflation rate year over year, you might look at this and say, well, we haven't actually gone as high as we were back in the 1970s and 1980s, so it's not as bad as it was back then. The problem is that the way they calculate this now is different than the way they calculated it back then. And I can't verify this, but there are some websites that attempt to track this stuff. There's an argument here that if you use the same methodology as we used back in the 1980s, then inflation year over year was well above 10%, right? And back up in this region. It's just the issue is that the methodology changes. So when you look at it over a long period of time, it seems like it's better than it was back over here, but perhaps the only thing that's better is our way of calculating it, or maybe you would consider it's not better. So that's sort of one of the things that I do somewhat take issue with, and I'm not saying they're never allowed to change how they calculate how they're calculating CPI. I'm not suggesting that it's part of some manipulation game or anything like that, but it does make it difficult to really assess long-term trends if the methodology behind the calculation is changing sort of midway through a rate hiking cycle to combat the very thing they're trying to measure. So I will at least say that. But if we can look past that, because I imagine the market will anyways, so why don't we just look past it? Inflation came in at 6.4, headline inflation. Now, where did core inflation come in? Because arguably core inflation is a more important measure, and PCE, of course, is what the Fed's going to care about anyways. But core inflation came in at 5.6%. The consensus was 5.5, but it's still lower than it was a month ago, right? So you have headline inflation and core inflation down slightly. They're higher than the consensus view, but still somewhat disinflationary. So then the question becomes, well, what's going on here? Well, first of all, we know one thing, and that is that risk assets have done somewhat okay today. I mean, it's easy to cherry pick various things, but I mean, right now the S&P is up 0.04%. It might feel better than that because it went all the way down below 4,100, but then earlier today it was all the way up near 4,160, so it's sort of just been all over the place. But risk assets have done somewhat okay today. And this sort of goes back to what one of the things we talked about is, as long as you see inflation come down, and as long as the economy is not deteriorating, then speculators are still going to speculate, right? There's this idea, an ongoing idea of a soft landing where the Fed can just raise interest rates to combat inflation, and it's not going to have a material effect on the U.S. economy. So what I want to do, though, is sort of look at this in the context of what happened before. So this is core inflation. So you can see if we look back, say like a year ago, 6.4, 6.5, 6.2, 6, and then 5.9, 5.9, and then it started to go back up again, right? So then the ultimate question, right, and this is something you have to ask yourself, because of course no one knows the answer to it, is it showing that the trend is starting to shift back the other direction? Because remember, risk assets can do well as long, in my opinion, right? This is not a fact. I mean, it's just my opinion, and my opinion can easily be wrong, and it's been wrong many times. But risk assets continue to, can do well as long as you don't see either inflation reaccelerate or the economy deteriorate. Acceleration of inflation has not yet occurred. It's still going down, but the question is it starting to change its direction, kind of like it did back over here? You can see, if you look back over here, it was 6.5, 6.2, 6, 5.9, 5.9, and then it accelerated back up to the upside for a while. So the question is it doing that again now, or is this just sort of like a fluke and it will continue down next month? We do have an example of that as well, right? If you go back and look at headline inflation, there was actually a period back over here in August and September where you had essentially 8.3 and then 8.2, and then it was all of a sudden, okay, well, what's going to happen with headline inflation? Is it going to come back up? No. What happened? It dropped a lot in October, right? It dropped from 8.2 to 7.7, which is a pretty big move, year over year, going from only 1 month to another. So it dropped 8.2 to 7.7, and then 7.7 to 7.1. So this was sort of like a concern, but it did not materialize in any type of real acceleration by inflation to the upside. It still has been a disinflationary process. And again, I think you could argue that because of that, risk assets have done well, and you still have the unemployment rate at a secular low at 3.4%. So then, of course, we remain in this transitionary period. The other thing I'd like to take a very brief look at is the inflation rate month over month, because this is something to take note of. And if this goes in the wrong direction, things could accelerate pretty quickly if you see 0.5 start to be the new norm or even higher. Okay, because we were trending down, right? It was in October, it was 0.5, then 0.2, then 0.1. Now we're back at 0.5. So then the question remains, well, is this going to go back up to the upside? And this is a very tough game for the Fed to play, because as long as risk assets continue to rally, you're going to have this, wealth effect take over, where essentially, if people feel wealthier because their portfolios are doing well, they're more likely to spend money. And if they're more likely to spend money, it means the demand is going to be likely be higher. And if the demand is higher, then the price of these goods and services can continue to go up, just simply because the demand is still there. So it's sort of a game that the Fed has to play of, sort of trying to tame the market back down, but not doing it in a way that leads to a hard landing. But we're going to dissect this a bit more than just simply looking at this website. So what I want to do now is we're going to look at, so this is the into the Cryptoverse website, of course, so inflation year over year. Okay, so let's take a closer look at this. 6.35% headline inflation. All right. Now you zoom in. Well, maybe I zoomed in a little too much. Let's try to capture this whole area, right? So it moved up, right? Hesitated for a little bit, right? We got into the idea that the Fed said, inflation was transitory. They were wrong. It continued higher. And then now it started to come back down. So then the question is this significant? And this is something we mentioned, right? And if you go back and look at the last video we did on inflation, we mentioned this, that, this is moving down right now in a linear fashion, meaning you're basically seeing the rate of change to the downside essentially stay constant. If you go look at, if you look at the inflation rate, you went from 8.2 to 7.7 to 7.1 to 6.5. So we were seeing very similar levels of sort of stepping down in this disinflationary process. I mean, it was pretty good moves every single month. This month it is not made that same type of move, and you can actually see that. You take the monthly change of this, the derivative, right? So now we're looking at the derivative, the monthly change, and you can see that it was more or less linear because it was around negative 0.5, negative 0.6, negative 0.7, somewhere in that area. Okay, so staircasing down. Now it's gone back up. Now you have to be careful how you read this chart, because if you just look at this chart, you might say, oh, well, this means inflation is going back up. This is not what it means, right? It's the rate of change. As long as it's below zero, inflation is still going down. It's just the rate at which it's going down is not as high as it once was, right? So, at one point, if it was going down, a certain amount, which was good, right? Let's say 0.5%. Now it's only going down less than 0.1% or so. So you need to remember that as long as it's below zero, the disinflationary process is still technically there. So even if we were to go sideways here just below zero, it would still mean that inflation is coming down. It just might not be coming down as quickly as the Federal Reserve would like it for it to come down, but it is still in fact coming down. If it goes back above zero, that's where you start to get in trouble, right? And that's where you start to see risk assets probably get a little bit spooked by that. And you can also take a look at core inflation, right? So it's coming in at around 5.6% or so. And so this is just what it looks like, right? So if you zoom in, it's slowly moving down here. If you take the monthly change, of course, and the rate, if you look at the rate of change, right? So sorry, I need to zoom in a little bit better here. So if you look at the rate of change, it was somewhat linear and it's paced down, right? So this was negative 0.34%, then negative 0.33%, then negative 0.268%, and then now it's negative 0.156%. So again, the issue here is not, we're not seeing inflation really accelerate. What we're seeing is the disinflationary process is not remaining constant. Therefore, what it means is that inflation is sticky, right? It's somewhat sticky, and it's not going down as quickly as the Federal Reserve might like it to. Okay? So that's where it becomes an issue, is if this trend is not transitory, right? So like if this trend is not transitory and it continues, then it's only a matter of time before we're back above the zero mark, meaning it's only a matter of time before inflation starts to accelerate back up to the upside. So that's the risk that the Federal Reserve is trying to balance right now, right? They want to remain hawkish so that you don't see a huge resurgence of inflation, but they also are likely not looking to crash asset markets. Okay, because I know a lot of people might say, well, why don't they just raise by 75 basis points or 100 basis points and just rip the Band-Aid off and get it over with? They're trying, they want to keep the music going, right? I mean, they're not looking to just absolutely destroy risk assets. I'm sure they would just love for us to just be range bound for another year at least, so they can try to get inflation out and ultimately achieve that soft landing. So this is what you have to look at: the rate of change. That tells you how strong the disinflationary process is. And so the real thing to think about too, the next meeting by the Fed is not until March 22nd. So what does that mean? We're going to get another CPI report before they meet again. Okay? So that's where we can figure out, is this a fluke? And does it continue to come down? Does headline inflation next month come in at 6%? Right? Does it come in at 5.8% to show that this was a fluke? Or does it come in at 6.7% and show signs of reaccelerating? That, I think, is what investors have to weigh right now. Is this a sign of a changing trend, or is it just a fluke? And the truth is I don't know, right? I simply don't know. And, I was looking going into this report, you have all these banks making out predictions as to what they think inflation is going to come in at. And I'm sitting here thinking, these banks have way more resources than I do, and none of them can agree on where inflation is going to go, at the next meeting. So how could I possibly know where inflation is going to come in at any given month? But that is the risk I think we have to currently weigh: is this a fluke and it keeps going down, or is it showing signs of a reversal? Okay? And if it is showing signs of a reversal, then what it means is the market is likely underpricing the terminal rate. So going back to the terminal rate, and this is something we followed for a while, roll back the clock a year ago, and we said, right, they're likely going to make it. Back then, I said they're likely going to make it, the terminal rate, somewhere between 4 to 5%. And then maybe 8 months ago, I said they'll make it to at least 5%. You can see that the market is suggesting that 5% is basically a shoo-in at this point, because they're not even considering, the Fed pausing at the next meeting. Literally, zero consideration going into that right now. We have almost a 91% chance that it's going to be a 25 basis point rate hike, and then about a 9% chance it'll be a 50 basis point rate hike. But listen, I think it's pretty safe to say that unless something crazy happens with inflation at the next, I mean, it's probably going to be a 25 basis point rate hike, right? Like I don't think they're going to go back to 50, mainly because it would probably spook markets too much, right? Like everyone talks about a pivot, but what if the pivot that comes is the Fed just getting more hawkish again? I don't think that's the most likely scenario. I think the most likely scenario is just another 25 basis point rate hike. What remains the most uncertain is how many more 25 basis point rate hikes are we going to get? Because it was only a couple of months ago when markets were essentially suggesting that the Fed might stop after the meeting in February. But now markets are saying something completely different. Take a look at this. Not only does the market think we're going to have a 25 basis point rate hike in March, it also thinks we're going to have another 25 basis rate hike or a 25 basis point rate hike in May. Furthermore, the market is also suggesting another 25 basis point rate hike in June, putting the terminal rate right now at 5.5%, with a small consideration of it being 5.75%. But again, this is not a likely scenario. And I think the most likely scenario, as the market suggests, that we'll be at 5.25% to 5.5% by June, somewhere in that area. Well, what would cause the Fed to go to 5.5%? Well, I mean, if the labor market remains secularly tight and inflation reaccelerates. If you see inflation start to reaccelerate, I think they're going to keep just not, cranking out the 25 basis point rate hikes. I'm not that convinced they're going to go back up to 75 or anything like that. I mean, I suppose if inflation gets really bad, then maybe they go back to 50. But I think the most likely outcome is just more 25 basis point rate hikes until they see real progress is what I would guess. So you go out to July, the market is even talking about a 6%, a 6% terminal rate, which I know is not a likely outcome. But the fact that the market is even considering it is a huge change from what the market was considering just like a month ago. Okay, this is a major shift in a repricing of the terminal rate. And what's interesting is you look at July, market thinks 5.5%. So again, June, market thinks 5.5%. July, market still thinks 5.5%. So the market is saying, all right, well, the Fed will likely pause sometime this summer. September, the market still thinks 5.5%. November, still at 5.5%. And then finally by December, you get that first rate cut that the market is pricing in. If you go look at the probabilities here, so you can kind of see the path. So at this first meeting, the next meeting in March, it's likely going to get up to 5, and then 5.25, and then sit at 5.5 for most of the year, and then come back down by December, with a 25 basis point cut. What's interesting about this is that, and I'm trying to think about this, is that every time we see this change, the market pretty much relentlessly predicts a cut in December. The level to which that cut goes is what changes. So now the market is predicting a cut still in December, but it's cutting it back to 5.25, which at one point wasn't even considered to be the terminal rate, right? The terminal rate was like 4.75 or 5. Now the market says, all right, the Fed will cut still in December, but they're just simply going to cut back to what previously was going to be the terminal rate. So the market is obviously having a hard time figuring out exactly what the Fed's going to do. If you look at the comparison tab and look at December, and you look to see where it was, say like a month ago on January 13th, and the most likely outcome, right, was 4.75 by December. Look at that. With a 32.7% chance, it was going to be at 4.75 by December. Here it was going to maybe even a 4.5, 30 to 31% chance of it being a 4.5 by December. But now, so that was January 13th. Then on February 7th, it dropped down to only a 23% chance about being in that range. Then on February 13th, it dropped down to about a 15% chance. Now the market says there's only a 6% chance of this happening. And the chances that it's only 4.5 is only 0.77%. Look at what's been going up. It's where it is at 5.25. The probability of 5.25 has been going up from 3.48 a month ago, 3.48%, to 25% chance, to 32% chance, to now a 36% chance. And that 36% chance is also coupled with a 26% chance it'll be at 5.5 by the end of the year. So I look at this and I say, well, no matter what the Fed has done, no matter what the unemployment rate has done, no matter what inflation has done, the market still thinks every single time we get more data, the market still thinks it's going to be a rate cut in December. So then I guess the question is, well, what does the market know about December that everyone else doesn't know? You know? And I mean, again, I don't know the answer to that question. I wish I did. I don't know if perhaps it's the market's way of saying, you know, the Fed's going to raise rates and they're going to continue to hammer the economy down. But at some point, something will give. And that's the issue, right? Like at some point, if the Fed continues to remain hawkish, continues to raise rates, continues to roll off assets from the balance sheet, eventually something's going to give. It's just a matter of how much time is it going to take to get to that point, right? This is what at least history shows us, is that it's only a matter of time. And the only question is how long do they need to keep rates elevated? Because as long as they keep rates elevated, they're still, you know, they're still providing a relatively hawkish view. They're still sucking liquidity out of the system by rolling off assets from the balance sheet. It's just a matter of how long do they need to do that before the markets really, you know, really start to feel the effects. And this is suggesting it'll take until December. Okay, now think about it like this. The Fed has already said, they've been clear, no rate cuts this year. All right, they've said it many times. They said no rate cuts in 2023. They've said higher for longer. They want to see the softening of the labor market. Despite all of that, the market says, no, you're going to cut in December. But here's the thing. What would cause the Fed to cut in December? What would cause them to cut? I mean, if inflation is still high, they're likely not going to cut, right? So will inflation be back down to 2% by December? Probably not the most likely outcome if we don't have a recession between now and then. Now, if we have a recession between now and then, there's certainly a possibility that occurs. But without a recession, I don't think you're getting to 2% year-over-year inflation by December, okay? So what would make the Fed pivot? It would be something breaking in the economy is the most likely outcome, right? Because they've already been clear that they're not going to cut rates in December. So the only reason they would cut rates in, you know, this year would be if something breaks in a catastrophic fashion, right? Because then they're essentially forced to pivot. You know, if we have a big credit event or something of that nature later on this year, they'll have to. I mean, at some point they'll have to. And it's only a matter of time. History shows us that, you know, no matter what, right? No matter what, eventually the Fed will pivot. It might not feel like it, right? But eventually they will. So the Fed keeps saying, hey, we're not going to cut rates this year. The market is saying, we don't really believe you. We think you're going to cut in December. The question, of course, is, well, if they're cutting in December, what's going to happen to make them cut in December? Okay, so clearly I think you could argue that the market is a little bit concerned about all of these rate cuts, but they're not concerned about them just yet, right? That's the key thing. And that's, you know, you go back to the S&P 500 and you say, well, why does it continue to rally? And this is something we've talked about for, you know, a month or two now, is as long as the disinflationary process is in place and as long as the economy is not crumbling with, say, a fairly quickly deteriorating labor market, then speculators are, as always, going to speculate. So that's kind of where we currently sit. So again, market doesn't seem that too concerned right now about these, you know, about this stuff, but at some point something's going to have to give, right? Because the economy at some point will need the Fed to pivot for us to go back into another phase, I think, of expansion where the S&P rockets off to much higher levels. I don't think the S&P is going to be going to 6,000 or 5,000 for that matter during a period of quantitative tightening, something, unlike what we've seen. I mean, the fastest rate hiking cycle that we've seen in basically ever, So that's currently where we stand. The other thing I thought that was at least worthwhile, and I know I'm getting somewhat long-winded, but I don't really make that many videos on inflation and interest rates and that sort of stuff. But take a look at Treasury yields. They're breaking back up to the upside, right? Look at the 6-month. The top of this, I mean, if it wants to keep running, 5.25 could easily be on the card. It's already at 5. So 5.25 is not that much higher. Look at the 1 year though. A clear breakout of the 1 year. Clear breakout. It was in this range from October. Note, here's something to consider. It broke into this range in October. That's where the S&P bottomed, by the way. The S&P, the problem is if yields are going up quickly, then it gives investors an area to put their money in to get the risk-free rate. And as long as this continues to go up, investors are going to start to think, at what point does fixed income investing become more attractive to people than throwing their money in risk assets? And I think, as this continues to go higher, it's going to start calling the name of more and more investors to say, well, to hell with all the risk. I just want to earn 5% for at least a portion of my portfolio. Obviously, most people aren't going to do it with everything, but even if it were a small amount, 5 or 10%, could have a material effect on risk assets if people just start to, throw some of their money into cash and say like certificates of deposit or T-bills, whatever it might be. The 1 year is breaking out. The 2 year breaking out, right? The 3 year putting in a new local high, not higher than where it was back in November, but it's higher than where it was in January. The 5 year is moving higher. Remember, the Fed does not control the long end of the yield curve. They control the short end. Okay, look at the short end. The 1 month right now is at 4.5, 4.5, 4.6, but the Fed funds rate is like 4.75. So the Fed controls the short end of the yield of the curve, not the long end. Because look at the long end. The 30 year is at 3.8%. Now, why is the 30 year at 3.8? Well, eventually the market just simply says, they're not going to be able to keep rates here forever, and the market, sort of sniffs out potentially upcoming weakness, and the which will force the Fed's hand likely to cut rates back down, and so the 30 year is still not even at 4%, but it has sort of broken out of this. It was, we have a high and then a lower high, and then we had a low and then a higher low and then a higher low. And rather than get rejected here, it broke out, right? It's breaking out. So the question is how much longer is this actually going to run, before it settles down into sort of like a new range. So one last thing to consider, and that's probably it. I'm not going to make any promises, but one last thing to consider is that as the risk-free rate, let's just call the risk-free rate the 2 year Treasury yield, right? Let's just say that that's what the risk-free rate is. 4.6%, right? So the issue right now, of course, for some investors is that 4.6% is still below inflation. It's not. Let me see if I can pull this up in a better way. So let me add a metric here. So the Macroverse. Let me add recessions on here. Actually, I like to have that on there just to have as like a base there. Let me look at yields, Treasury yields. So we'll add that. What I want to do is add the 2 year. So we're going to add the 2 year onto here. Let's get rid of the 3 month. So here's the 2 year Treasury yield, right, on a linear scale. And now what we're going to do is we're going to add inflation. So headline inflation. So on the same scale, of course. Sorry. This is Y. Let's switch this to Y2. Okay. So right now you have the risk-free rate. Let's call it the 2 year Treasury, right? The risk-free rate. Still below inflation, right? So if you were to go put your money in, say, like a certificate of deposit, right, and you get 4 or 5%, congratulations, right? You're getting 4 or 5%. The downside is that you're still losing purchasing power because the debasement of the U.S. dollar, right, it's being devalued. Okay, the counterpoint, and one of the reasons why in 2022 I just sort of touted cash as king constantly is because, well, I'd rather put my money in that than watch it go down 80% in the altcoin market, right? So yes, it's not like we're under the impression that putting it into the risk-free rate is going to, lead you to becoming super, super wealthy or anything like that. But if you follow that view, especially in 2022, of just preserving capital, then it's not so bad, right? It's not so bad to lose a few percent to inflation if you don't really see what the alternative is. Right? And that's why, cash in 2022, cash is king, right? And I still think in 2023, there's going to be various phases of the year where cash is king, but it's not as obvious as it was in 2022, okay? Because you're still going to have, I think, these sort of transitionary periods where risk assets can do well for a while and take out some prior levels. That doesn't mean they're not going to come back down and retest some of the lows they put in. So the a potential regime shift, or like a change in investor behavior could be when the risk-free rate goes above inflation, because then now it's just, you're getting a nominal return, right? But when the real return is greater than zero, then it's going to become more of a talking point. Right now, some investors are just not going to be interested in fixed income investing for a number of reasons. First of all, who wants to get 5% when investors just had a decade of chasing much higher gains, right? They're not conditioned at this point for being content with, say, 5 or 6% annually. That's just not something that a lot of people are going to be happy with at this point. But it doesn't mean we're not heading in that direction eventually, right? I mean, you could argue that is ultimately the direction we're heading, where we're going more towards a world where you actually have to think about the price to earnings, ratios, and you actually have to think about what projects are actually providing decent fundamentals and real utility to the world. When interest rates are effectively zero and cash is cheap, then everything can basically go up. When cash is not cheap, then it forces investors to spend more time considering which projects are actually useful, because the cash isn't as cheap as it once was. So they have more limits on the capital they can actually get. But when the risk-free rate goes above inflation, that's when you have to have a consideration, because then you're talking about, well, the real yield. Imagine the risk-free rate is at like 5.5%, and inflation is at 3.5%. Well, then your real return could be, if your real return is a couple percent and it's essentially risk-free, then there are going to be some investors that are going to be content with that, right? It's just how it is, right? There are going to be some investors who are going to be content with doing something like that. And it doesn't mean they're going to put their entire portfolio into something like that, but to have a portion of it in it is a way that you can hedge, right? You can hedge by having a portion of it in, say, fixed income investing, where no matter what the market does, you're going to get a small return in this portion of your portfolio. So it's a way to hedge, right? You have crypto, you have equities, of course, you have other things, you have commodities, you have real estate, but you also have fixed income investing, which is not something that my generation, right? I was born in 1990. That's not something that we've really had access to when you think about it. I mean, go look at U.S. interest rates, and this is inflation. U.S. interest rates. I mean, I graduated high school in 2008, so I graduated basically during that during the financial crisis, and interest rates were at 0.25%. This is the first time in my investing career where I feel like I look at this and some level of fixed income investing makes sense. Now, it's not to say putting everything into it, but some level of it can make sense because it's going higher, right? It's like, well, how's it going to go? So I think what a lot of people are have been doing and have been continuing to do is getting some of the some of the CDs or T-bills for certain periods of time, letting them run their course, and then sort of figuring out, do they want to renew them, or what do they want to do, and then sort of going from there. But we're in a very different phase right now than we've been in for the last 10 years. I mean, fixed income investing has not really been an attractive option for a lot of people for a long time, just because rates were basically zero. There was a brief period over here where they raised rates, but they just cut them right back down. So now we're at the levels that we haven't been at since the last time we were at this level was in September 2007. And I believe if we go take a look at the 6 month, the last time the 6 month was here was also, all the way back over here in March 2007. It's been a long time, okay? So it's just not something that a lot of investors have had access to for a long time. And you could argue that there's been a price to pay for basically depriving investors of the risk-free rate, of a decent risk-free rate, for so long, because so many people just are not interested in this form of investing when they're so used to everything just being so cheap and fundamentals not mattering, et cetera. It's basically the only investing environment that I've ever known. So I'm trying to do the best job I can at looking to see, what does history tell us about this sort of stuff, because I can't speak from my own experience. I can't even speak from my own experience with regards to a recession. I wish I could. I wish I could, come on here and say, well, in my experience, this is how recessions normally shake out? I can't, because the only recession that has really occurred that was substantial. I mean, of course, you had the very brief one in 2020, but I mean, it was so short. You have the one from from the financial crisis. You have the one from the dot-com crash. But again, I wasn't even out of high school, so it's hard for me to speak from experience. So all I can really do is look for pieces, anecdotes from other people, look at the data, and try to make as much sense of that as I can. So sort of putting a bow on everything, going back to risk assets in general, the thesis remains the same, right? As long as the disinflationary process is intact, and as long as the unemployment rate has not moved up in a material way, or you've seen some type of a credit event occur, which has not yet occurred, as long as that is as long as the status quo remains unchanged, then risk assets continue to do well, right? The biggest question we must ask ourselves is this a sign that inflation will reaccelerate, or is it just a fluke like it was back in August of 2022? And that's the question you must ask yourself. I'm not offering financial advice. You just have to figure out, what do you think is going to happen, and ultimately make the decision for yourself. Eventually, we're going to have to face, can the economy sustain all the interest rate hikes by the Federal Reserve that they did in 2022? Eventually, we're going to figure that out. But they didn't really start raising rates until March, right? So we're not even a year away. We haven't even reached the year mark from their first rate hike, this rate hiking cycle. We're going to reach that next month. And so we'll start to see how these rate hikes are actually going to affect the economy, the effects they'll have on earnings, and of course, the effects they'll have on things like the S&P 500, the NASDAQ, and the Dow Jones. Thank you guys for tuning in. Make sure you subscribe. If you're not subscribed, give the video a thumbs up. Remember, we also do have Into the Cryptoverse Premium at intothecryptoverse.com. We do have several different tiers available, including a free one. Make sure you guys check it out. We put out a weekly newsletter just for signing up. Just give it your email address. Links down in the description below. All right, guys, we'll wrap it up. We'll see you guys next time. Bye.